The second part of credit control methods used by RBI are the qualitative credit control methods. The qualitative credit control methods are also known as the selective credit control methods. These techniques under the qualitative credit control, the RBI tries to ensure an adequate credit flow to the particular desired sectors, and also through these methods the government and RBI tries to control the flows to the really needful section and tries to control the excessive credit flow to the non-priority sections. So under the qualitative credit control methods we have the following sub methods. Directions. According to the section 21 of the Banking Regulation Act, uh, power is given to the RBI for granting and controlling the advances which is made by a particular commercial bank. So the RBI can give directions to the commercial bank to control the credit provided by it, and also it can use its control power to maintain a certain amount of advances, and also the margins to be maintained, the interest rate, this all can be controlled and maintained by the directions method of selective credit control. Number 2, rationing of credit. The rationing of credit first started in 1960s. The RBI shows differential treatment in extending financial assistance to its member banks according to the purpose for which the credit is used. So, the RBI frames different eligibility rules for various kinds of paper and offer differential rates of discount. For example, we can say that the RBI, if it finds that the bank is providing loans to priority sectors such as agriculture, a low rate of interest is being fixed. Whereas if it is the loan is or the advance is for suppose a private businessman, the rate may be higher. Margin requirement. Margin means the difference between the market price of security and loan amount. So changing marginal requirement is another credit control method followed by the RBI. So what is this margin requirement? Now suppose you want a loan of rupees 1 lakh, but if you go to the bank you are not going to get the total 1 lakh as loan. There is the margin requirement. For example, if it is 10%, then you will get the loan of 90,000 and 10% will be your, that is 10,000, it will be your margin requirement. Now this margin requirement is changed by the RBI to control the amount of credit given by the commercial banks. Credit monitoring arrangement. In 1988, credit monitoring arrangement replaced the credit authorization scheme. So under this credit authorization schemes, the commercial banks were required to obtain RBI's prior approval for sanctioning any fresh credit of rupees 1 crore or more. So this technique intends to ensure that money borrowed from banks are actually utilized for the purpose for which the credit was extended. That is, if the commercial banks are to forward loans of 1 crore and more, it has to give a detailed summary of the loan, the need of the loan, the objective of the loan, to which person it has given the loan to the RBI, so that RBI can properly scrutinize whether the loan is actually being used for good purpose. Moral persuasion. The RBI also exercises control over credit by the method of moral persuasion. So the method of moral persuasion refers to the commercial banks from refraining to lending for speculative purposes, to reduce the level of advances, to increase investment in government securities, to invest in liquid funds, or to achieve a certain target. So this measure helps to a great extent and has been proved quite successful in the Indian economy. And the last one, direct action. So direct action helps the RBI when all the other methods in proves to be ineffective. So under the direct method or direct action method, the RBI has been granted statutory power by the RBI Act and Banking Regulation Act to take certain direct actions when certain banks, if they do not follow a certain set of protocols. So the RBI has the power to cancel license of banks, refusing grant refinance facilities, putting lending restrictions on the banks, or not permitting opening of new branches, etc.